So in that case, we're gonna have some algebra first, right? Now, suppose the plowback ratio is B. So what is plowback ratio? Plowback ratio basically means that how much is reinvested, so how much out of earnings are reinvested into the firm, right? Into firms' other projects, for example, right? Now, dividend will be equals the payout ratio times earnings, right? How much is paid out to the shareholder, right? And payout ratio is 1 minus B, right? So because B is plowback ratio, so how much is goes to the earnings, right? So in that case, D equals 1 minus B times E, right? So in next period, the same relationship holds, right? So D prime is the next period dividend, E prime is next period earnings, right? Now you can see D prime divided by D. This is 1 plus dividend growth rate, right? It will be equal to ROE times book value. So it will be D prime divided by D. It is 1 minus G, right? It will be equal to the earnings next period divided by earnings this period, right? So I mean, just using this one divided by this one, right? It will be 1 minus B times earnings next period divided by 1 minus B times earnings this period. It will be earnings next period divided by earnings this period, right? And what is earnings, right? Earnings is ROE times book value of equity, right? And here this ROE times book value of equity this period, right? And then ROE is fixed, right? So ROE cancels out. So it will be equal to the growth rate of the book value of equity, basically, right? What is book value of equity next period? It will be the book value of equity this period plus the reinvested earnings, right? I mean, what is reinvested earnings, right? It just goes to investment, right? You buy a machinery, you buy some kind of infrastructure, right? They are all part of the assets. Oh, sorry, they are all part of the book value, right? Now, then it will be equal to 1 plus, right, reinvested earnings divided by BV, right, book value of equity, right? So what is reinvested earnings, right? It's basically ROE, right? So basically that will be 1 plus reinvested earnings divided by BV, right? And then G will be equal to reinvested earnings divided by BV, which is 1 minus B times ROE, right? So what is reinvested earnings? It will be plowback ratio times earnings, right? Right. And then what is, for example, plowback ratio? It will be plowback ratio times ROE, right? So this will be the idea. Now this is how we get this formula here, right? So it will be G equals reinvested earnings divided by book value, right? This will already show. And then it will be like reinvested earnings divided by total earnings times total earnings divided by book value, right? And then it will be plowback ratio, which is this part times ROE. And then it will be equal to 1 minus payout ratio times ROE. So that will be the idea. So let's look at an example then if we know this formula holds, right? Suppose this company starts with plant and equipment 100 million and is all equity financed, right? ROE is equal to 15%. Total earnings will be ROE times the book value, right? So it will be 15 million. And then there are 3 million shares outstanding, so earnings per share will be $5, right? And suppose the plowback rate is 60%, then the value of the firm asset will increase by 9%, right? So this we already show, right? Plowback rate is 60%. So the value of the firm asset will increase by 9%, right? Because it's 15% ROE times the plowback ratio. This is how much the book value of equity will grow, right? And then endowed with 9% more assets, the company earns 9% more income and pays out 9% higher dividend, right? You can see there are 3 things here that grow at the same rate: dividend, earnings, book value, right? So these are the 3 things. Keeping this in mind, right? Now, using this alternative approach, suppose our payout ratio is 60%, our plowback ratio is 40%. So in that case, we can calculate the dividend growth rate, right? So which is plowback ratio times ROE, which what we get is 4.4%. Then we can calculate the market cap rate, right? So the problem using this approach is that we estimate from fundamental characteristic of the firm, like financial ratios, right? And the problem is that we assume there is a regular fixed future growth, right? So it will be an approximation. Realistically, in financial crisis, this assumption might not hold, right? So in financial crisis or in like coronavirus, many companies actually stop paying dividends, right? So this will make this regular growth rate of dividend a kind of failure in some sense, right? And also there could be errors creeping to the estimate of growth rate G, right? So that's why investors sometimes they take the average of estimates, right, from different approaches, right? So for example, you take the average of the annual estimates, any estimate from the fundamental characteristic, right? So that will be a better estimate, right, to minimize the error. And in this, there's also a special case, which is preferred stock, right? So preferred stock, in this case, there will be like fixed dividend, right? So there's no growth. Then it will be just like valuing a preferred stock will be just like paying a fixed dividend of $2 per share when the discount rate is 8%. So in that case, dividend growth rate G will be just equal to 0, right? That's just a special case. Now, if we look at the constant growth DDM equation, so price equals the first period dividend divided by K minus G, right? So in that case, there will be 3 implications, right? The first implication is that the stock's value will be greater if the dividend per share is larger, right? And then it will be greater if the market cap rate is smaller, right? And the value will be higher if the dividend growth rate is high, right? So just think about that equation. And the stock price is expected to grow at the same rate as dividends, right? Remember, this is D1, right? So price equals D1 divided by K minus G. That's why stock price will grow at the same rate as dividends, right? For example, suppose this company wins a major contract for the new computer chip, right? And then the very profitable contract will enable it to increase the growth rate of dividends from 5 to 6%, right? And the current dividend is $4 per share. The question is, what will happen to the price and what will happen to the future expected return, right? Now we can calculate the post-announcement price, right? So which is D1 divided by K minus G. And we have all the parameters here, and we can get a price, right? And we can also verify that at this new price, the expected rate of return on the stock is 12%, right? So this is what we use to calculate this price, right? And it will be just like the market cap rate or the expected return before the contract was announced, right? So we can rearrange them and get 12%, right? So you can see this is the impact. Now, a variation of the DCF model is the DCF model with 2 stages of growth, right? Because you can see in the constant growth DDM, we assume there's only 1 stage, right? Why is that? Because we assume that there is a fixed growth rate of dividends, right? The growth rate doesn't change, right? Now, in this model, we're gonna relax this assumption and allow dividend growth rate to differ in 2 stages, right? So suppose there's a company called Growth Tech, right? This company has dividend equals 50 cents, right? And the price equals $50, right? And the plowback ratio is 80%, and the ROE is 25%. So in that case, we can calculate the dividend growth rate will be equal to plowback ratio times ROE, which is 20%, right? And assume the future growth rate is 20%, right? And we can derive the market cap rate, right? So what is market cap rate? Market cap rate is dividend yield plus G. So what is dividend yield? Dividend yield is 50 cents divided by $50, which is 1%, plus 20% dividend growth rate, we get 21%. This is the market cap rate, right? But in real life, we won't be able to sustain this dividend growth rate, right? Because ROE over time will gradually decline. right? Because if you are a growing company, your ROE will be bigger, right? Over time, competition will drive the ROE to smaller, right? So ROE will decline over time. So that's why we assume that there are two stages of growth, right? Assume that ROE suddenly drops to 16% in year 3, and the firm responds by plowing back only 50% of earnings, right? You can see previously what is the plowback ratio? It is 80%. Now the plowback ratio is lower, obviously because the ROE is lower, right? So ROE is only 16%. That's why the plowback ratio goes down to 50%. So then the dividend growth rate drops to 8%. So again, using the same formula, right? ROE times the plowback ratio. Now we have two stages, right? With two different dividend growth rates. So suppose we have 4 years, right? From the 4th year and on, the dividend growth rate is 8%. Before 4 years, like 1st year, 2nd year, 3rd year, we have a very, very high growth rate of dividends, right? And this table also provides you all the necessary information here, right? Book equity, earnings per share, return on equity payout ratio, dividend per share, right? So year 1, book equity is $10 per share, earnings 2.5, right? The payout ratio is the same as plowback ratio. Oh, sorry, payout ratio is 20%, right? Plowback ratio is 80%, like we just said, right? And that's why $2 is the plowback ratio, right? Because how do you get $2? $2 comes from 2.5 times 80%, right? Now this $2 is plowback earnings, right? It goes back to the book equity, right? So that's why in year 2 we start from book equity of 12, right? And then in year 2 the payout ratio is 80%, right? Sorry, 20%. Plowback ratio is 80%. So 12 times 80% plus plus the original book equity. And then we have 14.4 in the book equity in the 3rd year, right? So that's the idea. Then in that case, in the 3rd year, like we assumed here, right, ROE goes down to 16%, and the firm earns only 2.3 earnings per share, right? So, and then dividend go up to 1.15%, right? So therefore, the subsequent growth in earnings and dividends drops to 8%. So this is also we assume, right? We assume that from the 4th year and on, there's a 2nd stage where the dividend growth rate goes down to 8%. Here the dividend is actually 1.15, so there's no percentage sign here. Now we can calculate, right? So we can calculate the price then. So in year 3, investors in year 3 will view this company as offering 8% dividend growth rate, right? So we can calculate the P3 here, which will be equal to all the future dividends minus the dividend in year 4 divided by K minus G, right? So this will be like constant growth DDM, right? The growth rate is 8%. For the first 3 years, we already have the dividend per share here, right? We just take these numbers into the equation, right? So if the price is 50, right, we can calculate the required return, which is 9.9%, right? Now you can see if we still want to have this price equal to 50, then it's much lower, right? The required return will be much lower than the required return if we have we do not have a constant, we do not have a 2-stage, we only have a 1 stage, right? If we have 1 stage, that will be the 21 will be the sorry, let's go back. Right, so if we only have 1 stage of dividend growth, then 21%, this will be the required return. But if we have 2 stages of growth, then the required return is going to be lower, right? Obviously, because in the 2nd stage, dividend growth dramatically goes down, right? So that's why it decreases the required return investors want on the company. So in the first stage, years 1 and 2, the growth tech is highly profitable, right? And the clawback ratio is high, right? And book equity, earnings, dividends, they increase by 20% per year, right? In the second stage, the dividend growth goes down to 8%, right? And the dividends jump up to 1.15 in year 3 and also grows at 8%, right? So this is kind of idea. So then let's look at another example here, right? So this company is gradually regaining financial health after a near meltdown, right? Suppose the company's equity is growing at a moderate 4%, right? And then ROE in year 1 is only 4%, right? 4%. So this company has to reinvest all the earnings, leaving no cash for dividends, right? Because the ROE is really low, right? Now, when the ROE begins to grow in years 2 and 3, then the company decides to pay out dividends, right? For example, 31 cents in year 2 and 65 cents in year 3, right? Finally, starting year 4, this company settles in steady state growth, right? With equity, earnings, and dividends all grow at 4%. Right? Now we can apply this dividend growth model with 2 stages of growth to calculate the price. Right? So this is how we do it. So basically, so now you can think about it, right? So initially we have 1 stage growth, right? Dividend growth, there's a single dividend growth rate. Now we have 2 stages of growth, right? Suppose we have a later stage where the company becomes mature, then it has a different or slower dividend growth rate, right? Now we're gonna look at dividend growth rates for different reinvestment policy, right? Because we know that when we estimate the dividend growth rate from fundamental, we know that it depends on the clawback ratio. It also depends on the payout ratio, obviously, right? So that's why dividend growth rates will be very different if you pursue a different reinvestment policy. Right? Suppose we have 2 companies, cash cow and a growth prospects, right? And then each company has expected earnings of $5 per share in the coming year, right? And then both companies, they could in principle pay out all of the earnings as dividends, maintain a perpetual dividend of $5 per share, right? So in that case, they don't have to reinvest anything, right? And if the market cap rate where K equals 12.5%, in that case, both companies would be valued at $40 per share, right? So remember, there's no dividend in this case. So therefore, G is equal to 0, right? So then neither company will grow in value, right? Because all the earnings are paid out to as dividends. Now, suppose this company grows prospects, they engage in projects that generate a higher return than the required return, right? So if this company retains or plows back some of the earnings into this particular more profitable project, it can earn a 15% rate of return for the shareholder, right? If the company pays out all the earnings as dividends, it forgoes the projects, leaving only 12.5%, right? So now you can see, obviously, shareholder would want the manager of this company to pursue or engage in this project that offer a high return, right? So suppose this company chooses a lower dividend payout ratio of 40%, maintaining a clawback ratio of at 60%. Now the company does not pay out all the earnings to shareholder, right? They claw back some of them to reinvest. So in that case, the retained earnings will be put into use to invest this 15% rate of return project, right? And then the dividend paid out is 12.5%. That's how do we get it? That is the clawback ratio times the clawback ratio times the ROE, right? So this is how we get it. So this is dividend paid out, right? And then so that in that case, the dividend of the company will be $2, right? So now you can see the dividend growth for these 2 companies with 2 earnings reinvestment policy, right? So one company with the black line, right? you can see their dividend is lower in the beginning, right? Because they reinvest their earnings into more profitable projects, right? In the future, they have a higher dividend per share, right? Because the more earnings they get from investing those more profitable projects enable them to pay higher dividends in the future, right? So that's why investors, they should really consider maybe engaging like more profitable projects in the early stage, right? In order to get more earnings in the future. So this basically summarizes what I just said, right? So now let's take a break and we will come back. Okay, so let's continue and finish the rest. So let me get back to the reinvestment policy, this part, and explain a little bit better. So now, so remember how we started, right? So there are two companies, then both of them, they can choose whether to retain earnings or not, right? Initially, all of them, they paid out their earnings as to shareholder and earn 12.5%. Now, one of the company, Growth Prospects, they have the opportunity to reinvest their earnings into a more profitable project, which offers 15% rate of return, right? So now, this company chooses a lower dividend payout ratio of 40%, right? The clawback ratio is 60%, right? So in that case, the contrast is if the company retain earnings, right? Meaning that the company plow back some of the earnings into the future to invest this more profitable project. The company is going to get 15% rate of return, right? If they do not retain earnings and paid out all the dividend, they're only gonna earn 12.5%, right? So this is the idea. Now, if they follow this reinvestment policy and pay out only like 40% out of earnings, right? The dividend of the company will be how much, right? Will be the EPS, right? $5 per share times the $40 dividend payout ratio, which we will get. Dividend will be $2, right? So you might wonder that whether the stock price of the company will increase or not, right? I mean, because we say that stock price depends on the expected future dividends, right? The answer is that the stock price will increase. Why? Because we already see this graph here, right? Because if in the early years you sacrifice the lower dividend payout ratio and invest in projects that are more profitable, ultimately you're going to have a higher earnings profile, right? So that's why stock prices, they are the collective judgment of the future prospects, right? So that's why in the future, investors do believe that this company will have a higher earnings profile, right? So that's why the stock price will actually increase, right? That's the idea. Okay, now we're gonna go to the last part of this valuation, right? So we're gonna talk about the linkage between the stock price and earnings per share. Right? We're gonna decompose the stock price into basically two components, right? So which we're gonna talk about here. So suppose the company does not grow, right? If the company does not grow, then the expected return of the company will be just equal to the EPS divided by the share price, right? So because why? Because the company does not grow, right? So that's why all the dividends, all the earnings are paid out as dividends, right? That's the idea. So the company does not plow back any earnings, right? So that's why all the earnings are paid out as dividends. So that's why the expected return of the company will be just equal to the EPS divided by the share price, right? Because dividend will be just equal to the EPS, right? Now suppose the dividend is $10 per share, stock price is 100, right? In that case, expected return will be equal to dividend yield, right? Which is earnings price ratio, right? So EPS divided by earnings price ratio, right? So which will be $10 divided by 100, right? Which is 0.1, right? And the price obviously is gonna be 100, right? So that is the dividend divided by the expected return, right? Which gives you 100, right? So this is when the firm does not grow at all. Right? Now, it doesn't mean that for growing firms, the expected return should never be equal to earnings price ratio, right? For growing firm, they can also take projects where the expected return is also equal to earnings price ratio, right? They can still take projects, right? It's just that the return from these projects might just be equal to the required return of the company. Therefore, it does not affect, so meaning that it does not provide a superior return. So in that case, expected return of the company will still be equal to earnings price ratio, right? The key is that whether earnings are reinvested to provide competitive return, meaning that at least equal to the required return, right? Now, suppose the company has the opportunity to invest $10 a share next year, and each subsequent year, the project gives you $1 per share, right? In that case, the net NPV per share at year one will be equal to 0, right? Because you invest $10, right? But each year you're gonna get $1. The project gives you $1 cash, right? So, and then the discount rate is 10%. That's why you get NPV equal to 0. Now, if NPV is 0, that means taking the project or not doesn't affect the firm value, right? So in that case, the decision has no effect on company's share price, right? Now, in that case, you can see when it's NPV equal to 0, the market cap rate, it is still 10%, right? Right, so that's why the stock price does not change, right? So this table provides you different scenarios where the NPV is different, right? Where the firm is taking different kind of projects, and then it shows the different impacts on the stock prices, right? So you have 4 projects, right? One project offers 5%, which is lower than the required return. One offers the competitive return of 10%. The other 2 offers superior return, right? And the incremental cash flow is how much the cash flow generates, right? 50 cents, $1, 1.5, $2, right? In the first case, the project delivered, the NPV of the project is -5. The project NPV year 1 is -5, right? The project's impact on the share price in year 0, so this one is just calculated by discounting this NPV into year 0, right? Which is negative, right? So in that case, clearly you can see share price goes down, right? And we can also calculate the EPS, earnings price, so earnings to price ratio, right? EPS divided by price, which is 10.5, right? And then the required return is always 10%, right? Now you can see if the firm takes this project, right? NPV is 0, share price does not change. EPS to price ratio equals the competitive to the required rate of return. Now, if the firm is taking value increasing projects, like the third one, the fourth one, the share price increases, right? Because they have their NPV is positive. Of course, the share price increases, right? Now, in that case, you can see EPS to price ratio actually goes down, right? Even if the project is delivering a superior return, right? So now you can see only when the market cap rate only when NPV equal to 0, then the market cap rate equals the earnings price ratio, right? So that's why we should never confuse the earnings price ratio with the project return that we're talking about, right? Now, in general, we can decompose a company's price into 2 parts, right? The first part is price could be written as EPS, right? This is the earnings price ratio divided by the market cap rate plus the PBGO, right? So what is PBGO? It is the present value of the growth opportunity of the firm, right? So you can think about that the first component is the no growth policy. The company does not grow, right? Why it does not grow? Because you can see dividend just equals to EPS, right? And then dividend does not grow at all. So there's no G, right? So this is just when there's no dividend. When the dividend is just equal to EPS and earnings are never reinvested and the dividend does not grow, this is how much you can get for the company, or the value of the company under this no growth policy, under this no reinvestment policy, right? The second part is the rest of part is the PVGO, the present value of the growth opportunity, right? And we will explain what that is in a bit. So we can also reorganize this equation and get this one, right? So the EPS divided by P0 will be equal to K times 1 minus PVGO divided by P0, right? So if our growth opportunity is positive, that means if you are taking NPV projects, it will underestimate K. I mean, this EPS to price ratio, right? It will underestimate the market cap rate or the competitive return, right? And then we'll overestimate the competitive return if the PVGO is negative, meaning the NPV is negative, right? So this can be verified here, right? If we use the EPS to price ratio and compare to the return, right? Now you can see the first one is clearly a negative NPV project, right? But if you use the EPS to price ratio, this is definitely higher than the rate of return here, right? In contrast, for these positive NPV projects, if you use this one here, this will be lower than the project rate of return, which is 20%. So that's why for positive NPV projects, the EPS to price ratio will underestimate the return, right? So now we're gonna look at one example and look at what PVGO is, right? Suppose this company, the market cap rate is 15%, and then the company is expected to pay a dividend of 5% in the first year, and the dividend is predicted to increase by 10%, right? Now we can calculate the price directly, right? Price equals to 100, right? Now we suppose EPS is 8.33, right? Now we can calculate the payout ratio as 60%. And suppose the ROE is 25%. We can get a growth rate of the dividend by using the formula that we are already familiar with, right? Plot ratio times ROE, which is 10%. Now we can calculate, first of all, the no growth part of the price, right? In other words, it's the capitalized value of the earnings per share, right? So in that case, the no growth part is the EPS divided by K. Right, so let's go back to this formula here. Right, this part, right? This is the no growth part of the price. It will be equal to 8.33 divided by 15%. We will get 55.56, right? This is no growth component. And we assume that the rest of the price will be the PVGO, right? Net present value of the growth opportunity. Now we're gonna verify this, right? In the first year, suppose this company invests 3.33, right? So what is 3.33? That is 8.33. Is the EPS times the reinvestment ratio or the clawback ratio, right? And at a permanent ROE, 25%, right? And then how much cash does this investment generate? It generates ROE times this 3.33, right? And then you get 83 cents, right? Now from the second year and on, every year you're gonna get this 83 cents. So therefore, the net present value of this investment that you put in the first year is gonna be initial investment negative 3.33 plus the cash you're gonna get for every year and on, right? Divided by right? So 15%, you get 2.22. So you can think about this NPV as the NPV of the first project you're taking in the first period. Now, in year two, you're taking another project because you also reinvest, right? This time you reinvest 8.33 times 1 plus 10%. So remember, dividend growth rate. This growth rate is also the growth rate of the earnings. Is also the growth rate of the book value, right? Now again, you plot back 40%. So this time you invest 3.67%, right? And that's why you can get NPV in the second year, which is the initial investment plus this is how much you can get every year from year two and on, right? Right. So again, this cash also grow at 10%, right? So this is 2.44 you get. Now this NPV in the NPV of the project you're taking year 2 is actually 1 minus G times the NPV you get from the year 1. Right? Now you can think about the present value of the growth opportunity as a series of projects you are taking every year, right? Because every year you are reinvesting your earnings into some project, right? So that's why they are the payoff to the shareholder of all these projects, right? So basically, the payoff to the shareholder in total is the sum of the level stream earnings, right? So this is like no growth opportunity, right? Then a set of tickets that we calculated here, right? They represent the opportunity to take investment having positive NPVs. Right, the first ticket is 2.22, this one, right? The second ticket is 2.44, right? Right, so then you can see that every project, I mean, the NPV of every project grows at 10%, right? So then we can calculate the present value of all these projects, right? Which gives you 14.44, right? And then this is the rest of the price, right? Which is the PVGO, the present value of the growth opportunity here, right? So now we can verify this. Okay, finally, we're gonna talk about how to, like in general, how to value projects or value company, right? And we will touch on this when we talk about merger acquisition valuation. Basically, we value the company by discounting the free cash flow, right? And then free cash flow can be calculated this way. I mean, we'll visit this later. And then the firm value could be calculated, can be split into 2 stages, right? Just like we do 2 stages of DCF, right? In the first stage, this is like near term. In the second stage, this is like perpetuity, right? So, and then this VT here is the terminal value or horizon value, right? So this 1 to T, this is the near term, like 1 to 5 years, right? And then after 6 years, there will be another stage, right? Which will have a different growth rate, right? And then this is how we do the valuation, right? Now, if we compare this valuation model, right? The free cash flow approach that we just talked about here, right? But the basic idea is actually the same as DCF model, right? It's just that for in more general cases, right? In more general cases, any firm has free cash flow, but not any firm has dividend, right? So we just replace dividend with free cash flow. That's it, right? So in principle, the free cash flow approach is fully consistent with the dividend discount model, right? And then it should provide the same estimate of intrinsic value, all right? But of course, for a company that does not have the regular dividend discount, that does not regularly pay dividends, free cash flow model might be better, right? But of course, there are also problems with the DCF model, right? For example, calculation might be sensitive to small changes. Growth opportunity might be hard to pin down, right? So finally, we're going to talk about one example of using this valuation model, a kind of free cash flow version of the dividend discount model to calculate the valuation of a company. So basically here, free cash flow is the amount of cash that a company can pay out to investors after paying for investment necessary for growth, right? So this table, you can see the free cash flow is already here, right? So 0, 0, 0 in the first 3 years and then later, right? So it's already given. So, and then following the equation earlier, we have 2 stages, right? The near term, right? And then the kind of perpetuity from which the growth rate changes, right? So we need to first estimate the horizon value, right? Horizon value is when there is a different growth rate, basically. A period where you have a long run growth rate, right? And to estimate this horizon value, we need a free cash flow for year 7, right? Because we assume that from year 7, there is a long run growth rate, right? Or like a stable growth stage, right? And then a discount rate 10%, right? So in that case, the horizon value will be 27.3. Right, so this is the estimate. And then after we calculate this horizon value, which is like free cash flow in year 7 divided by K minus G, right? K is 10% minus G, G is 6%, right? That's why we get 27.3. But remember, we have to discount this horizon value to the present, right? And we get 15.4, right? And then the PV of the near-term cash flow, the first component of the valuation is 0.9 million, right? And then the present value of the company is this is the present value of the near-term cash flow plus the present value of the horizon value. In total, we get 16.3, right? And this is the final comparison of this approach with other valuation model. For example, suppose we use the PE ratio, right? How much do we get? Suppose we use the market to book ratio, how much do we get for the present value? All right, so this alternative valuation. Now, a further reality check is that we can also ask when will the industry likely to settle into competitive equilibrium, right? So this is when the PVGO is equal to 0, right? Because if industry is competitive, we all know from basic economic theory, there will be no abnormal profits, no growth, right? So in that case, PVGO will be equal to 0, and then the present value will be equal to earnings divided by R, right? This is the no growth opportunity. Right? So in that case, we use this one to calculate the horizon value and discount it to present, right? And then we get $12.3. Right? So then we have another estimate of the present value, which is more like realistic. Okay, so this is so much for the valuation of the stocks.